Entry-level hiring at big tech has collapsed by more than 50% since 2023. Youth unemployment across advanced economies now sits at 2 to 3 times the adult rate, the widest gap on record. This isn't a vibe. It's not avocado toast. An entire generation just got algorithmically deleted from the career ladder, and I'm going to show you exactly when, where, and how it happened. Let's start with the number that should be on every front page. Youth unemployment, that's 15 to 24-year-olds, is structurally diverging from adult unemployment in every advanced economy. In Spain and Italy, it's flirting with 25%. In France, it's pushing 17%. The UK doubled its youth jobless rate in under 3 years. Even Germany, the country famous for absorbing young workers through apprenticeships, is climbing. Compare that to the adult rate, which is near historic lows. Companies are still hiring. They're just not hiring anyone under 25. The labor market isn't broken, it's bifurcated. There is a job market for experienced workers, and there is a wall for everyone else. And that wall went up almost overnight after 2022. Now here's the counter-argument I get every time I post this data. Gen Z just doesn't want to work. Okay, let's actually look at that. If Gen Z were lazy, labor force participation, the share actively trying to work, would be in free fall by choice. Instead, what you see is something more disturbing. Youth participation didn't just fall. It fell while job openings were at record highs. In Korea, youth participation has cratered. In the US, it's still below pre-2008 levels, 15 years later. These aren't kids opting out for TikTok. These are kids who applied, got ghosted, applied again, got auto-rejected by an ATS, and eventually stopped. Discouragement isn't laziness. It's a rational response to a market that has stopped responding to you. The lazy Gen Z narrative is cope from people who got hired in 2014 and never had to compete with GPT-4. Here's where it gets ugly. While young workers were being shut out, the economy was booming. GDP per capita growth across the US, Australia, and Canada snapped back hard after 2021. Corporate profits hit record highs. The S&P 500 added trillions in market cap. By every macro measure, these economies are richer than they've ever been. So the question writes itself. If the pie is bigger, why is the youngest cohort getting a smaller slice, or no slice at all? Growth used to mean hiring. More output meant more workers. That link is broken. We are now in the first sustained period in modern economic history where GDP rises while youth employment falls. That is not a business cycle. That is a structural break. So where did the money go? Follow the capital. Gross fixed capital formation, the share of GDP that companies and governments pour into long-term assets, has surged in exactly the economies where youth hiring collapsed fastest. Korea is investing over 30% of GDP. Australia and Canada ramped hard. And what are they buying? Not desks, not training programs, not junior analyst headcount. They're buying GPUs, data centers, automation pipelines, and enterprise AI contracts. Microsoft alone is spending $80 billion on AI infrastructure this year. That money used to fund the bottom of the org chart, the intern, the associate, the grad scheme hire. Now it funds a model that does the same work for the marginal cost of an API call. The capital didn't disappear. It got reallocated, away from humans under 25. Zoom out one more time. Stack youth unemployment against the rest. The gap isn't just big, it's the widest generational divergence ever recorded in peacetime. In the UK, a 22-year-old is more than 3 times as likely to be unemployed as their 40-year-old manager. In France, 4 times. In the US, the under-25 jobless rate is climbing while the overall rate sits near a 50-year low. There is no historical precedent for this kind of split outside of a depression. Except this isn't a depression. The economy is fine. For everyone over 30. The career ladder didn't get harder to climb. The bottom 3 rungs got sawed off, and the companies that sawed them off are the same ones reporting record earnings on AI-driven efficiency gains. Connect the dots. Here's the verdict. Gen Z is not lazy. Gen Z is not entitled. Gen Z is the first generation in modern economic history to be locked out of the labor market while the labor market is booming. The data is unambiguous. Hiring collapsed, participation cratered, GDP soared, and capital flowed straight into the machines, replacing entry-level work. The career ladder that built every boomer's house and every Gen X retirement portfolio has been algorithmically dismantled. And we're pretending it's a character flaw in 22-year-olds. It isn't. It's policy. It's capital allocation. It's the deliberate substitution of junior humans for software. Until we name that out loud, nothing changes. The kids are not the problem. The ladder is gone. If you want the charts the headlines won't show you, subscribe. This channel runs on World Bank, OECD, and BLS data. No vibes, no narratives, just the numbers and what they actually mean. Hit subscribe. The next one is on AI's hit to junior coder salaries. And it's worse than you think.